been just an unbelievable run for gold. It's expected in any bull market that you're going to get some type of pullback. If you just check out what the banks are saying, right? Big banks really matter, in my opinion, because I come from a world of like Merrill Lynch, JP Morgan for most of my career, where a lot of these banks that I worked for were super negative, gold and silver, when I worked there. And now to see, Goldman Sachs at 4,900, Bank of America at 5,000, HSBC at 5,000 for next year. I mean, this is phenomenal.
John Feneck, CEO Feneck Consulting Group. It is a true pleasure to host you on Palisades Gold Radio today.
Great to be here. Thank you.
Excellent. Really excited to hit the ground running today, John. Of course, as we are a bit strapped for time, would love to get started with gold and gold miners. Specifically, we have seen a whipsaw on the gold price recently. Do you think this is just a process of shaking out weaker hands, or is this perhaps a structurally different phase in this gold bull market?
No, I don't think there's anything wrong here. I mean, if you look at the weekly closes, the quarterly closes, those are the things that, monthly closes, these are the things that traders look at, right? And we closed on a green candle last week, October 17th. And so this week has been disruptive, but remember, October 17th was a pretty bad day, right? Following 4 good days. So we still closed on a net basis well for the week. This week, we'll have to see, because we're recording this on a Thursday, and tomorrow is sort of the important day, right? But if we don't close with a green candle, that would be the first time in about 2.5 months, right? So it's been just an unbelievable run for gold. It's expected in any bull market that you're going to get some type of pullback. If you look at the NASDAQ, like QQQ, that had an amazing run up the last 2 calendar years, right? 23 and 24. And then when Liberation Day hit first week of April, that ETF just crashed and burned, and then basically recovered all of its losses and then some to today. So, we tell people, look, there's going to be volatility in this sector. It's not for everyone. But we think that gold is now like really should be part of people's portfolio. And we've been saying that for years, but I'm saying more of a mainstream thesis. And if you don't believe me, just check out what the banks are saying, right? Big banks really matter, in my opinion, because I come from a world of like Merrill Lynch, JP Morgan for most of my career, where a lot of these banks that I worked for were super negative, gold and silver, when I worked there. And now to see, Goldman Sachs at 4,900, Bank of America at 5,000, HSBC at 5,000 for next year. I mean, this is phenomenal, right? So if you're at 4,100 gold, you can still see a path to some real upside for next year just by holding the metal.
Excellent. And John, I would love to zoom out for a second and really get your take on what the long-term vision is for gold and the gold price.
Sure. Unfortunately, we don't really go too far out, just because in this world, there's just too much going on, in my opinion. Like, I mean, we give annual price targets, January of every year, kind of like everyone else. And in fairness, my target last year missed by $8. So I was at 2,800 in 2024. I got some street cred for that, but this year I completely missed the boat. I said 3,800 on the high side. So, here we are, 300 or so dollars ahead of that target. And so bull markets tend to run hotter than people think. This is true of real estate, true of probably crypto in some cases. Things just keep running, and we've seen that now with the broad market too, right? The NASDAQ, the S&P, the Russell. I mean, these things, according to Steph Pomboy, are floating on air, as she says, and that really is true when you look at charts of these 3 major indices since March of 2009. I mean, it's been a 15.5+ year run, so we have no exposure to the broad market right now, literally zero. We have 1 crypto stock, and we have I've sold 4 of my 5 houses over the last 2.5 years. So I'm not just telling people, hey, like we're reaching some tops here. I'm actually acting with my own money, because I think it's disingenuous when people come on shows like yours and say something that they're not doing themselves.
Really interesting to hear that about the broader market and the real estate market as well. Perhaps we can talk about gold miners for a second. Of course, oil is trading at a relatively low price. The gold price is an incredibly high price. So we should be expecting some incredible quarters. Should it also result in incredibly high stock prices, perhaps new all-time highs?
Are you referencing gold stocks as a basket, or?
Yes.
Yeah, I mean, GDX, which is sort of the barometer for me that I use, which is the biggest ETF that clients can buy out there, broke out to a new all-time high this year, eclipsing 2011 and 2012, which a lot of people don't realize because they own some really small juniors that may not be doing as well, right? But GDX and GDXJ are built with producers as the constituents of those ETFs. So producing gold miners have done extremely well. You look at Agnico, AEM, you look at Alamos, AGI, if you look at Newmont since January, my partner Don Durrett and I were talking that up on podcasts like yours at 35, 37, 38. Now it's at 88. It's like I honestly, Don said $100 by the end of the year, and he's probably going to be right, but I was more like in the 70 to 80 camp. I mean, just seeing this kind of explosive growth, I think will continue based on earnings, right? So we're going to see if my thesis is correct here in just a few days as earnings season starts to kick off for some of the constituents of GDX and GDXJ. But no, I mean, GDXJ is really interesting because the junior ETF trading around 95 right now, it hit a high of 179.10. That was back in 2011-12, right? Where GDX has eclipsed its all-time high. So it's really, the juniors still represent tremendous value, and that's why we spend a lot of our time these days in the smaller stuff. And we balance that with owning some producers too, if you wanted to talk about portfolio construction down the road here.
Yeah, would definitely love to. Before that, perhaps that 2011 high in the GDXJ that you outlined there, do you think it could be a major resistance for the junior market that it needs to break through?
No, when you look at something like silver, for example, silver touched 50 for hours in 1980 and in 2011-12. And now we just saw a serious strength here for days over $50 an ounce. That's really bullish behavior. And if you looked at GDXJ, I'm not looking at the chart right now, but I would imagine that was more of a spike high in a serious rally back then. And so I think that can be eclipsed, but it's not going to be this year. It'll be next year or the year after, I think. GDX, that's where in any rally you get gold usually rallying first and then the major gold stocks rallying second. And that's why GDX has broken out before GDXJ, in my opinion.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisade.ca and join us in our mission to level the playing field for investors. Now, back to the show. Well understood. I would love to transition to talking about your portfolio and really beating the market. I was looking at your track record for a second. You started your fund in 2016 and you're up over 1,000%. Quite a phenomenal return. What would you say is the big strategy behind the portfolio? Is the value investing portfolio? Are you more a growth investor? What are you guys doing over there?
We're value investors all the way. I don't chase anything. I mean, I will buy a growth stock if it's merited, but if it's up like 1,000%, like some of these rare earth stocks right now, I won't touch them because they will come back down to earth. And I don't like to trap followers and clients into stuff where they, buy something that goes from $8 to $55 and then it goes to 30 and they're like, what do I do with this? And it's in the middle of the range, right? Like, I'm patient. I'll wait for it to get back to 55 and sell if I needed to. But many clients are not patient. They're not going to wait around for months and months like I have, to get back to par on some things and also make some money on some other things. So we're patient. We have a 1 to 3 year hold kind of bias on a lot of the names we buy. But but really the thing that I think separates us is that we're very decisive. You know, some of my best clients have made their money in various industries by taking risk, and then deciding when things change and moving on, right? So like in 2016, my first year of a public track record, I distinctly remember I sold about half of my portfolio early August 2016 after that tremendous run up we had from January, because it had been running for 7+ months. And I was like, at some point here, we're going to see something change. And I don't trust the Fed then. I don't trust the Fed now. So Fed was coming up at Jackson Hole, Wyoming, you know, late August that year. Sure enough, Janet Yellen and her counterpart Fisher just blew it for miners, got very hawkish, and miners didn't do anything really from August or September of 16 all the way to early 19 when Powell came in and flipped the switch. So you have to be active in this sector, and you have to identify tops and bottoms, and I use a bunch of different things to do that. But really, it's a combination of technicals, looking at things like RSI, Relative Strength Index. You know, when silver topped out last week, it had an RSI of 84. Like, I mean, this is a metal, right? This isn't a company. So you kind of got a sell signal right there at around $54 an ounce. Not to say that it won't go higher. It's just that it needed a breather, right? And that consolidation, I think, is very healthy in silver and gold. But we combine technical, you know, stuff like support resistance levels, long-term charts, RSI, and we combine that with just picking up the phone and calling people. I'm very active on the phone. You know, I've called probably 11, 12 CEOs in the last 4 days here. And I just want to get an idea of like, hey, tell me about that public news you put out. How relevant is that? Or, you know, I saw in your PEA that, you know, your previous PEA didn't have anything about critical minerals, and now you're saying antimony is going to be contributing to revs in January, and tell me more about that. You know, that story literally was America's Gold and Silver, USAS. You know, I interviewed Paul Hewitt, the CEO, probably about 4 weeks ago, and he was saying, yeah, that's true. Antimony and copper and some things that we have as byproducts in our projects are going to start adding to our revenues starting January 1st. And that's one of the reasons I think that stock has taken off, is people are seeing, like, you know, that this is undervalued versus peers.
Really interesting to hear that, John. It sounds like do you think you're more of a bottom-up type of person where you're really looking at the story of the company you're investing in, or more top-down story where you're really trying to get, you know, leverage the trend that you're seeing?
I would say I combine fundamentals and technicals, so I'm sort of a GARP, you know, kind of manager with more of a value bias if I were to lean in one direction.
Yeah, it sounds like you're combining both to try to get the best of both worlds, try to pick the companies that might do best in the correct trend at the correct time.
Yeah, and I'm less interested in what's going to happen in 5 years. I mean, I'm much more interested in what's your 3 to 6 month game plan, because if the short term is good, it takes care of the long term with gold at 4,100 and silver at 48, right? It's like everything will start working if you can take care of the short term. And so I look for companies that put out news regularly, that aren't afraid to answer difficult questions, whether it's mine or some other host like yourself. You know, I want to see answers. I can read a report like a PEA. I can go to a deck and understand the positives. I want to know the negatives, because that's what can, you know, really trip you up in this market.
Do you think it's also a function of the stage of companies that you're currently investing in, as you identified that the juniors are showing a bit more value than the majors?
Well, juniors just have a lot less cash, and if you're not producing, right, you have to look at debt levels, and if there's no debt, then you have to look at their cash balance. And if they have $1 or $2 million in the bank and they're drilling, you know that at some point they're going to have to do a financing. And so those are the kind of things that I do a pretty good job of determining, because every company has different styles, right? Like some are just traditional, where they'll use a brokered placement, which typically will really hurt the stock, right? You're going to do 10, 15, 20 million bucks with a brokered placement. That means in 4 months and a day, there's going to be pressure as the hold comes off those shares, and people may sell shares and just hold the warrants. That's common, not with us, but that is common out there in the industry. Then you have the non-brokered, right, where a CEO might just call 20 of his friends and raise $1 million, and that's kind of cool, because then you won't have the same pressure necessarily, because those are friends and family or insiders that may be buying into that $1 million raise, right? So it's not as dilutive. And then you have this new kind of thing, life financing, which I'm not a huge fan of, because it seems that the pressure that's put on some of these stocks is immense. Like it's just, companies aren't raising 1 million anymore. They're raising 10, 12, 15, 18. And I'm like, whoa, it's putting pressure on these shares for weeks. And you don't want to see that in the best market of all time for gold, right? If you're buying a gold junior, you want that thing to run. So I kind of I have a consulting business, and I coach CEOs like, hey, do you really want to do that big raise right here? Why don't you do a bridge raise to get to where you have to go, but then do a bigger raise in 2026 when every bank and their mother is telling you 45 to 5,000, right? Like that's better than 4,100, right? So if you don't need to do the big raise here, try to do a smaller raise and then do a bigger raise next year.
Really interesting to hear how you're analyzing these different stories and trying to pick the correct stories to potentially become winners. Talking about, portfolio management for a second, how many stocks do you own at a time, and what is your capital allocation framework?
So right now we have about 60 stocks. I typically have between 50 and 70. I'm definitely, I've seen a lot of my peers that talk about 5 stocks or 10 stocks. I think that's nuts. Rick Rules talked about that. I worked for Rick. I'm not saying that Rick is nuts. I'm saying that, Rick is independently wealthy, and he has a lot more patience and a longer time horizon than the average investor, right? So I'm looking at days like Friday, October 17th, and Tuesday, October 21st, and saying if you have 5 stocks that got smoked, then you're in trouble, right? Whereas I had 60, 70 stocks, and I was down about 3.5% that day, but GDXJ was down 8 or 9, right? And so that's where, risk management comes into play. And we've handily beaten GDX and GDXJ over our track record because we don't go out there on a limb. When we see RSIs starting to get to 75, 80, 85, Barrick got to 91 probably about a month ago, and we sold a quarter of our position because I was pretty much forced to. I've never seen Barrick with a 91 RSI. I'm sure it happened, in 2011 and 12, but I don't remember that. We're constantly looking at optimizing the portfolio, which takes a lot of work. It's exhausting, but I want to have the best 10-year track record that I can post, and so that's coming up December 31st for me. It's been an interesting ride, but we want to drop that mic on the 10-year number and have it look really, really good. So I'm going to be busting it here between now and the end of the year, making sure we try to, squeeze every bit of alpha that we can out of the portfolio. And I don't think a lot of people feel that way. I think they, kind of set it and forget it, right? And we're not that way. We're active. We're at it every single day.
Really interesting to hear. Definitely 50 to 60 to 70 stocks sounds like significantly more than what most people have in their portfolio. But like you outlined, it definitely spreads volatility and therefore also drawdown risk. How do you view the concept of letting your winners ride versus trying to reinvest profits to generate alpha through that way? How do you balance those two concepts?
Yeah, that's a good question. So I think I do a pretty poor job of letting my winners ride all the way, because Avino, I saw 12 to 18 months ago, ASM is a great opportunity at 50, 60 cents. And then I sold it all between 2 and 210 because the RSI and other factors told me to. But in a hot market, again, you can get head faked even if you've been doing this a long time. And now that stock's at 510, right? So like I really missed that. But again, it was 1% of our portfolio. It's not a huge contributor overall. I did conversely let my top tungsten stock run here because I kept looking at the tungsten price going up, right? So the base metal is just cranking based on the fact that China produces 91% of that, and the U.S. has no solution for it. I mean, just cutting checks of $5 or $10 million to these mining companies is hilarious. It's not going to do anything to accelerate production because you still have to get through permitting, construction. It's going to be years before some of these companies can get it out of the ground. Meanwhile, tungsten is used in body armor, bullets, tanks, like stuff that is very much a defense metal. So that's our top holding. Guardian Metal is GMTLF in the States, GMET.L in London. And I got into that stock at 17.5 cents US. It's now trading at $1.40. And we haven't sold anything except when they did a $21 million raise. We sold 5-7% of the stock, just as a cautionary thing, right? Because I didn't know how a large raise would affect a junior, but believe it or not, it just like powered through that. It's unbelievable. So Oliver, the CEO, is a young guy, probably 34, 35, and he's just at it every day like I am. And I love people like that are grinding, because you have to right now. You have to go for it. This is when you can make life-changing money.
Thank you for taking us along for that story as well. And Tungsten, really interesting. Was this a bottom-up story where you found the company and that attracted you, or were you bullish on Tungsten beforehand?
Yeah, it's a good question. I didn't even know how to spell tungsten probably 3 years ago. So I just got referred to Oliver through another London hedge fund that I knew, who said you should talk to this guy. He's got kind of a similar work ethic to you. And to me, it's all about people, even before the jurisdiction and the project, honestly, because if you can trust someone like the CEO or the CFO or just the board, right? Like you have a lot more comfort level as you're holding that stock. To answer your question earlier of like, do you ride the winners? I didn't really know anyone in Avino. When I sent them emails, they didn't get back to me, that kind of stuff, right? Like I'm not comfortable with that. Whereas if I'm talking to someone every week or two, I'm very comfortable because I know exactly what my risk profile will look like if I'm being told the truth, which isn't always the case, right? In the case of GMTLF, I mean, I've never really heard anything that isn't, panned out, right? Like in terms of what he's been saying all along. Another tungsten stock that I just started to buy is Triumph Gold, which again is misleading by the name. But this is really the opportunity in mining where the ticker on that, by the way, is TIGCF in the States, TIG in Canada. I met John Anderson at PDAC this year, so I didn't know John even a year ago. But John's, been doing this 30 plus years, and he's got so many interesting stories of successes and failures, and this one's going to be a success. He owns about 10% of the stock. Michael Gentile owns about 8% of the stock. The biggest pension fund in Scandinavia owns about 8%. So when you start adding up who owns what, right? When you look at a website, sometimes you get bad information because you could see, okay, this stock has 200 million shares out or whatever, right? But then you add it up and maybe 50% of that, 100 million shares, is in good hands. And it's not getting sold at 18 cents US. It closed at around 19 cents today. But what really interested me there is their antimony and their tungsten exposure in the Yukon. There's actually a town in the Yukon called Tungsten. So like that's how prevalent tungsten is in Canada, but a lot of people don't know this. And so when I asked the second and third question and got their geologists involved, they said, yeah, we have like 15 million pounds of tungsten. And at current prices, that's extremely valuable. So why is that stock not doing better? Well, John's a conservative guy. He basically mothballed that project for 3 years up until this year. He wasn't doing any marketing. He wasn't putting out any news. And that's what actually prompted me to get in touch with him. I said, dude, you haven't put out news in like a year and a half. Like what's happening here? And then he's like, "Oh, that's a good observation. We're actually going to be starting that this spring." So, to his credit, he did a small raise, just kind of like we talked about, nothing huge, and eventually they're going to need some more money, right? But once that next tranche is raised, I would really be like all in on that, because what they're going to do is they're going to show the market, here's our gold, here's our silver, here's our tungsten, here's our antimony, and they're going to do that through the form of what we call a PEA, a preliminary economic assessment, right? And that PEA, the last one, was over 12 years ago. So at 12 years ago, gold's at what, like 1,100? I mean, I don't even know what they used back then. Let's even call it 1,500 to be fair. You're at 4,000. You're not going to use 4,000 in the PEA, but you might use 2,800. So how does the economics of that project look now at much higher prices for the metals? It looks really good.
Really interesting. That sounds like a story of being in the right place, literally at the right time as well. Are there other commodities where you're finding a lot of opportunity right now? For example, I've recently spoken to Rick Rule, who referenced zinc as one of them. Recently spoke to Edward Bonner, who referenced vanadium. Are you looking at any of those?
Not so much. I'm very focused on defense metals, tungsten and antimony, because I think the world is just at a tipping point. I mean, it just seems like the U.S. has really got its back against the wall here, and you're seeing Trump do something about it. You see the executive order he put out in March. He followed that by a kind of a doubling down in April by fast tracking certain projects. You saw August 13th, he did $1 billion kind of, credit to critical mineral companies. Rick actually put out something today where I got quoted talking about how that really is like the tip of the iceberg. That's really nothing in the grand scheme of things, and how much more money is needed, because the average American has no idea that, just using tungsten again as an example, that 91% of it was produced in China last year, and we produced zero. You don't catch up from 0 to 91 in 1 year or 1 month, or it takes years, and we're not prepared to wait years. So what is the answer? You're starting to see Trump go to Australia, go to different partner countries, even Ukraine, and start striking deals for critical minerals, right? That's what we have to do. And then, by the way, we should be permitting our own projects in the U.S. faster, and getting this whole ridiculous process moving. It's phenomenal. It's just unbelievable to witness when a CEO who's close to me shows me how much they've been through to get to where they are today. It's not like a year or 2 years. It's 3 to 5 years a lot of times, just to get whoever in their jurisdiction in that part of the U.S. to say, okay, you can make a construction decision now. Like U.S. Gold, I did a tour of their project in Wyoming about 2.5 years ago. It was around $4 then, and I was standing on top of their deposit, looking in all directions, and there were 4 ranchers and 5 ranchers maybe, as far as the eye could see. They had water. They have a great geo. They have a great leader in George B., who's built mines in places like Chile, Peru, at huge elevations. Like this is Wyoming. It's not a big deal. But even with Wyoming being a supportive state, it took them a couple of years to get to a full permit last November, and it's just ridiculous. Like it's like that's a copper gold project, by the way, and gold is pretty prevalent in the U.S., but starting new copper projects is not prevalent. Like even in the best jurisdiction in Arizona, it takes many years to get that permit, right? And so I think that's what Trump should be focused on more, and Besant. These guys need to focus right here in our backyard and say, how the heck can we get this red tape out of the way so we can become a competitive country in this part of the world, in this part of the investing world.
Definitely, point well taken. Of course, we've seen an incredible move in both antimony and tungsten due to those trade wars coming up. Do you think there's any way to predict which material might be next?
No. I mean, I would just stick to looking. You can Google search this. I mean, it's like AI can tell you. You type in a critical mineral, like you just mentioned, vanadium, and you can see what it's used for. I mean, that's always helpful, right? And if it's something that you think is kind of relevant, like some people don't care about defense, they care about tech, right? So there's a lot of metals that are used in technology, and you can kind of tell, okay, how. Then you search up publicly traded tungsten companies or vanadium companies, and you'd be surprised to see a list of about 10 maybe pull up, or 12. It's like a lot of these things are private, or they're like part of a larger company like a Rio or a Freeport or something, buried on page 30 of their deck. Like, it's not relevant to them. That's not their revenue source, right? Like their main revenue source. But that's why I like the small stuff, because when you look at the companies like I was just talking about, Triumph Gold and Guardian, they're heavily focused on critical minerals in their portfolio, right? And that's where you're going to see news flow coming from them, and eventually people will start taking notice of this. I think rare earths is a great example this year. Rare earths had been dead as a subsector for years and years and years. Now these things are just flying. Like, it's just unbelievable. And I think that's also not great. You have to really do your due diligence on these companies. Some of them, aren't that good. And we saw that with lithium like 3 years ago, right? Lithium just took off. Everyone just started piling into these stocks. A lot of them were lifestyle companies. They didn't work out. And you have to do your homework. And that's one of the things that we help our clients with is doing the heavy lifting, doing the work. It takes a lot of time to really dig into these companies.
I think this is a great time to ask you about the Feneck Consulting Group.
Sure. Yeah, we started, 6 years ago, almost to the day. I had spent 25 or so years prior to that, working with financial advisors exclusively in the U.S. And so a lot of my clients now are funds or financial advisors, and high net worth retail that see podcasts just like this and say, hey, what you're saying makes sense. How do I sign up for something? So we basically have three things. We have a newsletter for people that don't really have a lot of capital. I don't find that to be the most effective thing that we offer, because it is it's every 2 to 4 weeks, right? You're not going to get something in your inbox when you have a really bad day like Tuesday the 21st of October. To solve that, we have what we call real-time email updates, and that's kind of our bread and butter subscription. That's called the Mining Report on our website, and that includes the newsletter we just talked about, so you get that. But you also get all of our holdings as soon as you sign up within 24 hours. So you can see, okay, John's got this much in silver, this much in Guardian metal, etc. So you can mirror that yourself if you'd like. But then you get all of the transcriptions, right? Like this, like when I get done with this and you send me the link, I actually listen to this and then transcribe it myself. And I tell people, okay, I talked about Triumph Gold here, I talked about Guardian there. So if you're a busy executive, you're not going to sit there and listen to something for 35 minutes. You'll actually know where to go within an interview, and that's pretty useful too. But we also do, we let people know when we interview CEOs, which I do frequently. Don Durrett, my YouTube partner, has been doing this 10 years longer than I have. Don's just an incredible mind in gold and silver. And we do deep dives with the CEOs 3-4 times a month, and those all are included in the service. So you're getting those as soon as they go live to the public, so you don't get a head start, because that's really not fair. But we basically give it to you the nanosecond that it gets out there with notes. So I find, in this kind of a market, a little edge really helps. And it's a legal edge. It's just, are you willing to pay the money or not to be a part of the service? We get pushback from people like, wow, that's expensive. Not really. When you look at some of the percentage gains this year, we're up 118%. So you have to look at that and say, are you up 118%? And if not, how is that? Are you too conservative? Are you just not implementing trades as regularly as we are? We teach people also how to implement trades. We're not directing them into trades. That's not legal. But what we'll say is, hey, we want to buy something like ABC Mining. We'll put an order right there, right by the bid-ask spread, right? But then we put another order out there on a good till canceled basis that's maybe 10, 12% away from that action. So on a day like October 21st, we actually got filled on both, right? We get filled where we should be near the action, but then some market order comes, swipes the stock down 10% in a couple of trades, and we're out there buying it at 10% lower than we just did 2 hours ago. So that's one of the things that contributes to our performance, is having conviction and then developing a plan.
John, really appreciate your time and insights today.
My pleasure. Thanks for having me again.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.